What's this thing with credit that everyone say you need, but nobody really sits down to explain? It starts when you swipe that card or click Buy Now, Pay Later. Yay! Now you're the owner of new stuff, and you're not even spending your own money. You're spending someone else's, usually some bank's money, and every loan comes with strings attached. Always. So is credit a good or a bad thing to have? Welcome to the Wealth Explorer. Today we're taking a look at what's credit and what owning a credit means. Stick around and maybe hit the like button if you like what you're watching. We've normalized credit as if it's a natural part of life, as inevitable as gravity. But it's just another carefully designed product, which has been engineered to feel abstract. Swiping a card or tapping your phone generates none of the visceral pain of handing over a pile of cash. That dissociation's part of the central feature of credit. This is just the latest step in a long evolution. We went from trading real goods and services, to trading pieces of metal, to trading paper banknotes, to not even that. We've reached the peak of abstraction. Digital credit, numbers on a screen. The less real money feels, the easier it is to part with. And that's exactly how you spend more to the point of spending what's not yours. You're given cash to buy things up front, with a polite, "No worries, pay us back whenever." That plastic card's only a permission slip. This gives you temporary access to things the guys whose name is printed on top of the card pay for, and which by consequence are not really yours yet. Every single transaction made via credit, just like your high school education, is not complete. It doesn't matter if it's a coffee or a car. You get the product now, but the cash that paid for it was the bank's or some financial institution, and just as they let it go for your convenience, they want it back. Once they get their profit and the price for what you bought is covered with your sweat and tears, then it's a complete transaction. But why do you end up paying more than the original price? And why do some people pay a lot more than others? Interest. That's the fee for the inconvenience for using the bank's money. The longer you take to pay it back, the more that fee accumulates. Still, why do rates vary so wildly from person to person? Someone whose parents pay their loans on time, has stable income, and low existing debt is a safe bet. They get a lower interest rate, a smaller fee, because the bank is confident they'll get their money back. On the other hand, if it feels like someone will have to kneecap you in advance so you don't skip town too fast, or worse, a higher interest rate to offset that risk is charged, which is a calculation to preemptively offset the potential higher costs of getting back what's lent. So with greater risk comes great interest, Uncle Ben would say. How can people even fall for this? Well, the person who can least afford to pay extra is often the one charged the most to borrow. The cost of borrowing is a direct reflection of how risky the bank thinks you are, the size and likelihood that you will need to borrow, and how much it costs them to give you the privilege of being in their debt. Here's where the math can turn into a trap, especially if you don't like math, but you like shiny stuff. Global APR is a direct function of consumer culture and regulatory philosophy. Compare a vicious 40 to 65% in Mexico to a controlled 15% in China and a conservative 10 to 12% in debt-averse nations like Germany or Switzerland. This spectrum tells the whole story. On one end, products are engineered for maximum profit squeezed from debtors. On the other, they're treated as a simple utility that may help someone set up a company. It's the difference between offering a tool and setting a trap. So, let's see. Imagine you have a $1,000 debt at a 20% APR. The bank asks for a minimum payment of 5% this billing cycle. It feels manageable, so you pay it. That minimum payment is just covering the interest that will be charged in the beginning of next cycle or month, and assuming you're not spending a cent for the next few years, only giving back the hypothetical 5% every month, well, it's like trying to fill a bathtub with the drain open. After 10 years, you'd still be in debt since your monthly 5% payment first covers the interest that has accrued that month. Whatever is left over then goes toward paying down the actual $1,000 debt, also called the principal. If you're not prepared to liquidate what you owe as fast as possible, oh boy, then prepare to enslave yourself to the compound interest math. Adult life's a constant, relentless outflow of expenses. starting with the solid heavyweights such as rent or a mortgage, maybe a car lease, insurance premiums, as well as health insurance, because it seems that most countries are just too in debt with themselves or bankrupt to offer anything on your tax's behalf, such as healthcare. Then come the shifting sands. Groceries, utilities, gas, no gas. Maybe a credit for solar panels or a lease on those puppies, the unexpected repair of whatever, and a medical bill here and there. The potential for a single event to cascade into a catastrophe is an everyday reality. It happens both from the top down, a job loss, or an income that simply doesn't keep up with inflation, and from the bottom up, as the minimum payments on your debt themselves become a crippling monthly expense. If it didn't feel like already, this is when the doom loop begins. This loop isn't just fueled by your accumulating expenses or the background hum of inflation that everyone seems to just accept now that we are too distracted with pretty much anything. It's accelerated by the very tool you're told is the solution: more credit. At some point, drained and desperate, you get the idea to pay one credit card with another, effectively turning this into future use problem. Which brings us to an ancient word, one that feels almost biblical in its gravity: usury. Historically, usury meant charging excessive, predatory interest on loans. Its definition has varied across cultures and centuries, often being outright banned, as were its practitioners. Now, is a 25% or 30% APR technically considered usury in a modern legal sense? That's a philosophical and legalistic question for lawmakers. But what's undeniable beyond creeping bills is the feeling. It feels predatory because the system is designed to keep you in the loop for as long as possible. It's a slow bleed. And the sheer mundanity of it, the monthly statement and the automated payment mask the severity of the situation. You're paying more than the money you borrowed. You're paying for the privilege of being trapped. When you make a $50 payment on a $1,000 debt and $30 of it gets vacuumed up by interest, leaving you barely chipping away at the principal, legal definitions don't matter. You aren't someone's customer. You're another source of revenue of the financial institution that issued that plastic card. Hey, some people need yachts and hypercars. What do you want? Anyone trapped in this debt loop requires a radical plan of attack, because playing by the minimum payment rules isn't an option. The system seems to be designed for you to fail, so escaping starts with a psychological rebellion. So that's it for today, the mechanism behind most types of credit. But what can you do in case you're trapped in it? Well, stick around for part 2 and bring some popcorn along to see what's next. This is the Wealth Explorer. Remember to consult a licensed financial advisor when it comes to financial advice, which I'm clearly not. But if you enjoyed this video, then see you in the next journey.